Welcome to Explain the Charts, your go-to source for in-depth market analysis. Today, July 28, 2025, the EURUSD pair has experienced a significant and sharp decline, currently trading around 1.15916, down over 1.29% from its previous session. This notable depreciation puts the euro well on the defensive against the US dollar. Breaking news confirms that the terms of a new US pact have disappointed market participants, serving as a primary catalyst for today's sell-off. Furthermore, global equities have fallen, and the dollar has strengthened across the board, contributing to the euro's weakness. There's also a buy the rumor, sell the news dynamic at play as traders square positions ahead of a pivotal week for US markets, with the FOMC rate decision on Wednesday, core PCE on Thursday, and NFP on Friday. Now, let's turn our attention to the daily chart to understand the broader context of this move. Looking at the period from March 2024 through July 2025, we can observe a general uptrend, with EURUSD climbing from lows around 1.062 in April 2024 to recent highs near 1.17 to 1.18. Before today's significant drop, the pair had established a strong resistance zone around the 1.17 to 1.18 area, which aligns with the 78.6% Fibonacci retracement level at 1.1748 mentioned in the technical reports. The recent price action on the daily chart, leading up to today's news, also hints at a rising wedge formation, which is typically a bearish reversal pattern. While the full impact of today's 1.29% drop to 1.1589 isn't yet visible on the last completed daily candle, which only covers up to July 27th, we can anticipate a large bearish candle forming by the end of today. Let's zoom into the 15-minute chart to see the very short-term price action just before this major news hit. Focusing on the last few days of available data, from July 23rd to July 27th, we see that the market was largely consolidating within a tight range, primarily between 1.173 and 1.177. This period of relatively calm, sideways movement with small candle bodies and limited volatility highlights how suddenly fundamental news can disrupt established short-term technical patterns. There were no clear signs of an impending massive sell-off directly on these 15-minute candles, underscoring the importance of staying informed on macroeconomic events. The volume was generally consistent, indicating no major accumulation or distribution immediately before the reported fall. This tight range served as a coiled spring, ready to release energy upon a significant catalyst, which today was the disappointing US pact news. Now, returning to the daily chart to assess the post-news scenario based on reported current prices. The news explicitly states that the EURUSD has already taken out key support levels at 1.1663 and 1.1632. This breach of significant support on heavy news implies strong bearish momentum. From a technical standpoint, the next critical support levels to watch are 1.1560, followed by the psychological level of 1.1500. If the selling accelerates and breaks below 1.1500, we could see a deeper reversal, potentially targeting previous lows seen earlier in the year. For aggressive traders looking at resistance, the levels that were previously support, such as 1.1632 and 1.1663, will now act as immediate resistance. Higher up, the 76.4% Fibonacci retracement at 1.1686 and the 78.6% retracement at 1.1748, which held the highs on Friday, are crucial resistance points. Shifting our view to the hourly chart, although our provided data only extends to July 11th, it gives us a good sense of the market structure in the weeks leading up to today's event. In this time frame, EURUSD was trading in a relatively stable, albeit slightly choppy, pattern, largely oscillating between 1.168 and 1.175. This confirms the market was positioned for a potential pullback, especially with the overbought in the first half of the year sentiment highlighted in the news. The calm period on the hourly chart in early July suggests a market waiting for direction, which it received emphatically today. The volume on these hourly candles was consistent, but not indicative of the massive directional move we are witnessing today based on current reports. So, what does this mean for trading EURUSD now? In the short term, the bias is unequivocally bearish. The sharp drop today, driven by fundamental disappointment and breaking key technical supports, suggests further downside is likely. Traders should watch the 1.1560 and 1.1500 support levels closely. A clean break below 1.1500 would confirm a deeper bearish trajectory, potentially leading to moves towards 1.14 or even 1.13 in the coming weeks. Short-term bearish trades might look for retests of the broken support levels, such as 1.1632, to enter short positions. Conversely, bullish arguments for the short term are challenging, given the current strong selling pressure. A reversal would require a significant positive catalyst, perhaps surprisingly dovish Fed rhetoric this week or a dramatic improvement in U.S. trade relations. Look for signs of stabilization, such as large bullish engulfing candles on lower timeframes, but be cautious of dead cat bounces. For long-term investors, this current correction could present a buying opportunity if the price stabilizes around a major long-term support, assuming the overall bullish trend from 2024 is still intact. However, if the price decisively breaks below 1.1500 and deeper historical support, the longer-term outlook might shift to bearish. Always remember to manage your risk carefully, especially around major news events like the upcoming FOMC, Core PCE, and NFP releases later this week, which can introduce extreme volatility and unpredictable price swings. Pay close attention to how these events are interpreted by the market, as sentiment and positioning are often key drivers in currency pairs like EURUSD.